Hi everyone, and welcome to today's webinar on investing for kids. Now I'm very excited to have you join us as we deep dive today into the topic of investing for kids and how investing early can really help to shape their financial future. For those that don't know me on the line, my name is Hannah Hooper and I'm the Senior Investment Advisor in the Stockspot team. Now, in my role, I'm speaking to clients on a daily basis about their desire to invest for their kids or their grandkids to help give them the best financial start in life. So whether everyone on the line here is investing for whether it's your child, grandchild, or even a relative, it may be for a financial goal like their first car, perhaps their education, or even to go towards a home deposit. I'm hoping today's session will fill you with lots of information and also cover how Stockspot invests for kids and how we can help you to manage your money. Because at the end of the day, I mean, investing for kids is one of the greatest gifts that you can give them. And this webinar will cover all of the things that hopefully you need to know before you get started. So in today's session, I'll start by providing a bit of an overview on investing for kids with Stockspot. This will include why you should choose to invest over other options like savings accounts, as well as covering how investing with Stockspot works. I'll then run through some of the main benefits of investing for kids, followed by some common questions we get asked at Stockspot around investing for kids through the platform. Finally, I'll give you all an opportunity to post any questions that you've got, and you can do that throughout the session as well. We'll get to those in a live Q&A session where we'll be running through some of the more frequently asked questions that we get from clients as well. So before I kick off today's session, let's just do a quick bit of housekeeping. For any questions that you have throughout the session, please feel free to share these in the comments section on the right-hand side of your screen where it says post a comment. Now, I'll aim to get through as many of your questions as possible at the end of the session, but if I don't have time to come back to you, don't worry, we'll follow up personally after the webinar. Now, if you'd like to increase the resolution of the webinar on your screen, there should be a little cogwheel which you can click on at the bottom of your screen to enhance the video quality. And also, if you do need to drop off the webinar for any reason, don't worry, we'll actually record this and we'll circulate a copy of the webinar after the session over email, so keep an eye out. And finally, just a general reminder that any content in today's session is just general in nature and hasn't taken into account your personal or financial circumstances. So on to our first topic of the day, which covers an overview of investing for kids and why you may choose to invest over other alternatives like kids accounts or savings products with a bank. I thought it would also be helpful to cover off a little bit about how investing with Stockspot works and how easy and flexible we aim to make it investing for your children through our platform. So what is investing and why would you choose to invest in the share market over other common investment options like savings accounts? Well, investing is essentially the process of putting money into assets like shares, bonds, or even investments like property with the goal of growing its value over time. Essentially, it's a way to help make your money work harder for you by generating returns. Now, these returns can come from two components, which is capital growth or income from dividends from shares or distributions from ETFs. Now, unlike simply putting money into a savings account where interest rates in Australia have historically been quite low, investing actually offers the potential for much higher returns due to the power of compound interest and market growth. So whilst savings accounts are safe and a great option for kids, particularly for shorter term goals, investing into a diversified portfolio gives a much better growth potential over the long term. So the sooner you actually start investing for your kids, the more time they have in the market for their money to grow. And that can potentially turn small contributions into significant sums by the time they reach adulthood. In fact, on your screen, you can see here just $2,000 invested into a broad mix of investments, earning 7% per annum, with a regular top-up of about $100 a month, could give your child $66,000 by the time they're 21. So if you compare this to a savings account, which has historically paid about 2% per annum here in Australia, this could leave them over $30,000 better off by the time they're 21 over having it in a bank account. Now, I think for most kids, having a $60,000 nest egg by 21 is pretty incredible and hopefully would be enough to ease any financial burden that they'd be going through, such as maybe university fees or even contributing to their first home deposit. Now, what I love about this next slide is that it really drives home the importance and the benefit of starting early when investing for kids. So time is really our most valuable resource when it comes to investing. And this chart illustrates the benefit of starting later in life versus earlier in life. So if you were to invest $2,000 for your child or grandchild at 5 years old, for example, you can see, and if that was growing at, let's say, 7% per annum, by the age of 50, they would have nearly $35,000 more than if they started investing when they were 25. You can see that the investor who started when their child was 5 also experienced what we call exponential growth a lot sooner than the older child. This is due to the magic of compound growth. Now, compound growth in the share market is a bit like a snowball effect. So you can imagine a snowball running down a hill, or rolling down a hill rather. Now, as it's collecting more snow, it's getting bigger and bigger. In the same way, when you invest in the share market, your money can grow over time and you earn returns on your returns. So not just from the original amount that you've invested, but also from the profits that you earn through your dividends or distributions, which are then reinvested back into the portfolio. So this growth is so powerful. And I mean, in short, time really is the key ingredient that makes compound growth so powerful. And essentially starting early really allows your child's investments to benefit from that extra time in the market. And that can lead to significantly more wealth over the long run. So we've now looked at why you should consider investing for your kids. Let's have a look at how investing with Stockspot for kids actually works. So Stockspot offers you accessibility to a low-cost and diversified ETF portfolio. So for those on the line who might not be familiar with ETFs or exchange-traded funds, these are low-cost investment options, and they give you the exposure to many companies around the world. And the great thing about ETFs is that they also give you exposure to other markets like US shares and international funds that you may not be able to access through a normal share trading platform. So they're a great option to diversify across different markets around the world and also asset classes. So in your kids account portfolio with Stockspot, you can think of the likes of Nike, Google, Apple, all of those companies your child will own, as well as your Australian household names like your BHPs, your Woolworths, or your Commonwealth Banks. So essentially, Stockspot will use these ETFs to give you exposure to a range of markets, but also some other asset classes in our portfolios, like gold and bonds. And this really helps to arm them with some defense assets, which helps protect the portfolio if we do see any market volatility or when the share market falls. Now at Stockspot, we also make sure that you get a portfolio for you and your child that's tailored to you. So if you're a parent or a relative investing for kids, depending on your time horizon, as well as your risk profile and your investment goals, we can make sure that you're in the right portfolio to give you the best chance of success. So as an investment advisor, we actually issue every client what we call a statement of advice. Now, this outlines our advice to you, and it also talks to the portfolio recommendation and the basis of why we recommended it based on your financial circumstances. And also, if you have any questions, for example, around your investment strategy or which portfolio is right for you, you can reach out to Stockspot's advisors at any point. So we have a team here which we'd encourage you to get in touch with. We can chat to you about what you're investing for, what the portfolio recommendation is, and also any other questions that you might have. So you get that support along the way. Now, Stockspot also ensures that you have the right mix of investments. So this is what we call your asset allocation. Now, when you're investing for kids, or for anyone for that matter, your asset allocation will actually drive the majority of the returns in your portfolio. So at Stockspot, we actually hold a mix of different investments. We hold some growth investments like Australian shares, global shares, and emerging markets. And we also ensure that you and your child have exposure to other assets like bonds and gold, as I've mentioned previously. Now, bonds and gold really help to cushion the portfolio and protect you if there is any market volatility. Ultimately, though, kids do have a lot of time on their side, so often we'll see them invested in a higher growth strategy with a higher allocation to these different growth investments. Now, one of the other benefits of investing with Stockspot for kids is that you do get a lot of flexibility. And for example, the minimum to even get started with Stockspot is $2,000. So you'll also have full flexibility when it comes to your top-ups and contributions if you choose to. So you can top up as much or as little as you like into your account. And once you've made your first investment with Stockspot, our system will automatically invest your funds once your cash account has accrued about $500 or more. So that's that next investment trigger. Now, in my role, I'm often speaking to clients about perhaps automating or setting up a regular payment into their Stockspot Kids accounts. The benefit of doing that is you can really set things on autopilot and have your investment portfolio for your child sitting there a bit more set and forget. It also ensures that you're disciplined with your contributions and you don't forget to top up each month. But if you need to, for whatever reason, you can always stop your deposits. As I said, you do have full flexibility with how you want to contribute to the kids' account over time. So now I'm going to cover in this next session a little bit of, well, there's actually a lot of benefits for investing for kids. So I'm going to cover some of the benefits. And let's move on to the first one, which is around compounding of returns. Now, I think this is probably the most important benefit of investing for kids. It's really that compound growth effect that you get. And I covered this in my earlier slides. Albert Einstein once actually called compound interest the eighth wonder of the world. And some of the reasons it's so powerful for kids is that potentially with decades in the market, kids' investments can go through many cycles of growth. And this helps to allow their money to multiply and build on itself. Now, the beauty of it is that even the most modest investments for your kids can really grow into large sums over time. And we've seen this already through many examples I've shared today, but you can see this again from what you can see is our free investment calculator tool on the Stockspot website, where even a small contribution of $2,000 and regular top-ups, you can earn your child a lot more than probably any bank account could offer over a longer period of time, like 20 years. Now, this is because the power of time and compound growth really helps to build up that initial sum. So you don't need huge amounts of money to see big results when it comes to investing. And the earlier they start, the more they can take advantage of compound growth with smaller amounts. At Stockspot, we also have a really easy to use dashboard and app. So this helps you to keep track of your investments and also we prioritize accessibility and transparency. So with the click of a button, you can pop into your dashboard or your phone app and view your investments. We also house a lot of information in there around your account performance, any transactions, also things like your tax reports. So it's a really user-friendly and accessible app and dashboard, which you can pop into at any point. Now, depending on the age of your child or grandchild, I think it's also really great to show them the app and the dashboard so that they can keep track of the performance of the portfolio. It really helps them to keep them engaged and I think motivated along the way as well. Another cool tool that we actually offer our clients in the dashboard is called the Goal Tracker tool. So if you're setting up an account, I'd recommend checking this out. So it's a tool where you can set up an investment goal and you can essentially track your progress along the way. So if you were to set a goal, you can indicate a regular top-up amount or even just a lump sum that you may be contributing to your kids' account. And our investment engine will actually continually check in on how you're going and give you some handy tips to stay on track. So we know from the topics that I've covered so far that investing can be a better way to save than other alternatives like savings accounts for kids. But I also thought it would be good to talk through some of the other investment options on the market that many of you may have heard of. So a common question that I'm actually asked from some clients about investing for kids is if we offer or have heard of investment bonds and if they're a good option for them. So investment bonds essentially used to be quite popular about 10 or 20 years ago. They've become a little less popular, I'd say, in recent years. They're usually issued by life insurance companies. And they do have very different tax benefits to investing, say, in a Stockspot account for your kids. Essentially, investment bonds are like a tax-paid investment if you hold the product or the investment portfolio for over 10 years. What they do often come with, though, are much higher fees. And we typically see a little less transparency as well from investment bonds and poorer long-term returns due to this higher fee structure. So we actually have a really good blog, which we'll share with you in the comments section. And this is on investment bonds. It covers how they work, but it's also got some really interesting analysis that we've conducted on the top performing investment bonds in Australia. And you can see this visualized on the chart. So what the research has actually shown is that the returns on investment bonds have been less than a portfolio of low-cost ETFs, even when you take into account the benefits of the tax-free investment that you get. You can actually see here that the average 5-year returns of the major investment bonds in Australia, this is as of the 31st of December 2022, they've actually still underperformed the Stockspot portfolio, the Topaz portfolio. What we found is once you actually account for the higher fees and the poorer returns within these investment bonds, this actually erodes the returns, and it's more to do with the fees in this case. So the tax benefit that you do get is completely eroded, and you'd be better off investing in a low-cost ETF portfolio. So it's definitely worth checking out that blog. Now, another benefit of investing for kids through Stockspot is that you can engage them from even a young age. Now, depending on the age of your child, I definitely recommend showing them the app and the dashboard so that they're aware of their investments. But what we actually do for all of our kids' accounts is we will post out to you a little investor certificate. So essentially, you can pop this on your fridge. It really helps them to get excited about their investment journey, and you can gift it to them to congratulate them on kicking things off. Our parents and grandparents really love this, and it really helps to prompt conversations, I think, about how their investments are going over time. And I think another of the major benefits of investing for your kids is that you can really help to teach them these important money principles from a young age, which will help them essentially set themselves up for future financial success. I'm sure a lot of you will agree with me that unfortunately there's just not enough education within the schooling system, and there's no curriculum really to help them learn about these important money principles and money lessons like compound growth, even things like discipline and patience and delayed gratification when investing. So we at Stockspot offer a lot of educational content that you and your kids can read. We've actually also got a YouTube series, which you can see on our screen. I definitely recommend checking it out. So that provides a lot of great tips and activities that you can do with your child and talk to them about the power and impact of investing, and it keeps it engaging and fun as well. Now, one of the other benefits of investing for kids is in terms of fees. So I would say through Stockspot, one of the most special things that we offer is free accounts for kids whilst the portfolio is under $10,000 or whilst your child is under 18. So this is incredibly important. We want to help give them a head start whilst they're young, because the power of fees over the long term can really erode your returns, as I've covered previously. You can even see on this screen that if you were to save just 2.5% in fees per annum, and that could be costs like brokerage or a platform fee or fund fees, that can actually leave you over $300 better off over the long term from your investments. So there's a huge correlation between performance and fees. So if you can save as much as possible, particularly whilst they're young, it's a really good thing to focus on. And finally, one of the most important benefits you'll receive as a Stockspot client investing for your kids is that you'll actually be getting this ongoing advice around your investments. Because we automate so much of this process through the platform, you don't have to worry about doing any of the legwork, whether it's researching the ETFs, managing rebalancing, even working out the tax calculations. Everything is automated and done for you with Stockspot. So we will help to rebalance your investments over time. We also provide education and support along the way, and you can really leverage our team of advisors too to help with any behavioral coaching tips, or just to be a sounding board for any questions you have when investing for your kids when it comes to strategy or anything else along the way. So now on to the next session. I'll cover some of the common questions we get here at Stockspot when it comes to investing for kids. So the first question we get quite frequently is around, is the account going to be in my child's name or will it be in my name? So when it comes to our kids' accounts, we have a couple of options. The first option is that you can apply as an individual for your child. So what this entails is an adult, whether it's yourself or someone else, setting up the account where legally the investments are held in your name on behalf of the child. The other option we have is through a formal trust if you had one established. So if you had a family trust, for example, you can actually set up a kids account in the name of the trust as the entity. The key differences between these two options is really the tax benefits or implications. So investing as an individual for your child means that any tax liabilities associated with the investments are typically against yourself as the individual, although they are probably going to be very, very minimal year to year. When you're investing through a trust for kids, it's a trust that is a taxable entity. So with both of these options, the child is not the legal owner of the investments, nor the tax owner. So that's, I think, an important one to note, and definitely a common question we get asked at Stockspot. So yeah, the two options would be investing in your personal name, which is probably the most common way to do it, or through a trust. So second common question we get is around, should I have one kids account, or should I maybe combine accounts or have separate accounts rather for each of my kids? So this is actually entirely up to you and your preference. We have a range of different kids accounts and investors who choose to invest differently. Some people like to have all of their children on the one account. It's a little bit more streamlined that way, and perhaps you can actually contribute more into the account with a larger amount. Otherwise, if you want to have separate kids accounts, that's no problem at all. I suppose there are benefits of keeping them separate. Sometimes if the children are very different ages, for example, it can keep things a little bit cleaner if you have different deposits and contributions coming in for the different kids, and they may need to access it at different times once they're 18 or older. So what actually happens once they're 18 or older? So this is where they have the option to set up their own Stockspot account. So there's no obligation to transfer the assets to them when they're 18. At Stockspot, essentially, they can set up their own account from that age, or you can continue to invest for them and carry forward the investments until later years. And I do find when I'm chatting to some clients, they prefer to hold on to the investment portfolio until the children are 21 or even older in some cases. But at that point, you do have the option to either transfer the assets across to your child. This can be done through what we call an off-market transfer, which is a process we can chat to you more about at the time. Just involves some paperwork, and you can then transfer the assets from your name into your child's name. Now, the other option is just to sell down the portfolio, and then you can contribute that into their own investment portfolio. So both of these options do have tax implications at that time. So that'll be the main capital gains event, I'd say, for kids account clients, is when you're looking to transfer or sell the assets. So another common question we also get is around fees. So the Stockspot accounts typically, and certainly for a kids account, as I said earlier, there are no fees whilst a portfolio is under $10,000 and whilst your child's under 18. Once the portfolio grows above that point, it'll be 0.66% per annum as an all-inclusive fee, and that's for any balances between $10,000 up to $200,000. So it's still very low cost when everything else is included, and there's no brokerage or transaction fees. It's an all-inclusive monthly management fee. Now, when looking at the minimum amount to get started, it's only $2,000. So if you didn't even have the $2,000 initially, that's okay. You can even start chipping away at deposits into your Stockspot cash account. This money will accrue, and as soon as there's $2,000 or more in the account, we'll get your investment started. What we typically do is phase in the investments as well. So for portfolios under $10,000, we will start off with Australian shares and bonds with your first $2,000. And then as the portfolio grows, and probably by the time you've got about $7,000 to $8,000 invested, that's when you'll have all of the asset classes and investments. And that just means that you're fully diversified within the portfolio, which can help to optimize returns. But it can take time to get there. So that's why having a regular top-up plan is super helpful. And finally, can I withdraw my funds before my child turns 18? So yes, you can. The great thing is you've got flexibility, you're not locked in. And as I mentioned before, other products like even investment bonds do lock you in for about 10 years or more before you can actually benefit. With our kids accounts, because they're in your name or the name of a trust, you can lodge a partial withdrawal or a full withdrawal at any point if you did need to take some of the funds out. The funds would then be credited out to you in about 3 to 5 business days. So a very quick turnaround time as well for withdrawals. Now on to how to get started. So if you are interested in investing for kids or setting up an account, if you're not already a Stockspot client, all you need to do is head to the Stockspot website, click Get Started, and then you can choose that you're investing for kids. As part of this process, you'll go through a series of questions, and that's called your investment profile. So you can tell us a little bit about your investment goals and your time frame, even things like your cash flow needs and experience investing. We'll factor all of that in and give you a personalized portfolio recommendation for you and your child. Once you finalise submitting that application, should only take a few minutes, you can then essentially keep an eye out in your emails. We'll get in touch within a couple of days and send you your new cash account details. And that's where you can deposit when you're ready. So it's really as easy as that to get started. But if you did have any questions as you're going through that process, please feel free to get in touch with our team of advisors. And we're certainly happy to chat to you and address any areas of concern or questions that you have for the application. Perfect. So now on to our Q&A. This is a live Q&A where we'll give you the opportunity to share any questions that you have. I know I can already see here there's a lot that have come throughout the session. So thanks to everyone who's posted comments. Now's the time to do so if you haven't already. And I'm going to endeavour to get through as many of these as possible before the end of the webinar. Just flagging as well, if you do need to drop off for whatever reason, that's okay. Again, you'll get a copy of this after the session. All right, we've got a question here from Charlie. So when my child becomes of age, how do I transfer the portfolio, and what is the most efficient way of transferring holdings to my child? So this is a really common question that we get. Essentially, when your child's 18 or older, that's when they have the option to set up their own account. Once they set up their own investment account with Stockspot, you can do an asset transfer, which is that off-market transfer process that I covered a little earlier. Really what's involved with that is a bit of paperwork for you and your child to fill out. You'll both need to sign the form, and then we can organise to transfer the investments from your name across to theirs. This will typically trigger a tax event for the owner of the adult or the owner of the investments. I'd recommend getting some tax advice on this. So I'll preface, we aren't tax accountants and can't give specific advice. But typically when you are selling or transferring assets, it would trigger a tax event for you. So just something to be aware of. The other option is just simply withdrawing this money to then gift to your child. There's no cost to withdraw, by the way, from the Stockspot platform. So it's really then just the tax considerations to consider as well. Thanks, Charlie. It's a good question, one I hadn't properly covered earlier. And now we've got a question from Rena around, are the returns tax-free for children? So I think I've covered in our section on investment bonds and other investment products. There can be products on the market that do have a tax-free benefit. With the Stockspot portfolio, if you do earn any income, which you will from what we call distributions, and that's like dividends, you'll also earn capital growth. When you realise this income or capital growth, that's something that you do pay tax on typically. So it's usually taxed at your marginal tax rate if you're investing in your personal name, or if it's through a trust, it may have a different tax rate applied. So there aren't any tax-free investments with us, unfortunately. But what I would love to reassure you is we choose ETFs for many reasons, but one of the other reasons is because they are very tax efficient investments. So within the actual ETFs, there's very low turnover within the fund. So typically there's not much you will have to declare year to year from a tax point of view. When you do sell the portfolio and hopefully realize a nice profit, that will be something that you would be taxed on. One of the benefits of investing here in Australia as well is that if you've held for over 12 months and you're investing in your personal name, then usually the ATO will give you a 50% discount on whatever capital gain you've earned. So if you earned $10,000 in a capital gain, you'd only be taxed usually on $5,000, so half of the full capital gain. Again, that depends on your personal and financial circumstances, and best to get some tax advice to confirm if that applies to you as well. Okay, so we've got a question here from Kate. Can I have multiple kids' accounts? Yes, you can, Kate. So you can definitely have more than one account. Stockspot actually has a multi-account feature. So you go through your application, log into your dashboard, and then you can actually apply for your second kids' account. You can even run, technically you could have 10 accounts in your dashboard. We also see some clients investing through different accounts for different investment goals. So probably something I haven't covered is that if your kid or child has different investment goals in mind, you may actually want to set up multiple portfolios for them. One could be for longer term goals. Another one might be for something coming up in the next few years, for example. So we do have clients running multiple accounts for that purpose. But equally, if you have multiple children, you can have one account for each of your children. So it's all managed through your dashboard login. You'll see your accounts show up there, and you can just toggle into the respective account when you log in. We've got a question here around touching briefly about Stockspot savings as well, and the main difference. So this is a great question. So Stockspot Savings is actually a product we offer in conjunction with our portfolios. Stockspot Savings isn't a bank account, but it's more akin to a bank account or a cash product than our portfolios. So it can be suited for shorter term investment goals for your kids. So for example, if you needed to invest some funds or save for something coming up in the next 1, 2, or even 3 years, it may be better suited to Stockspot Savings. So what this is a high interest cash ETF. So it's still an ETF listed here on the Australian market, but it does pay a monthly distribution, which is similar to interest that you get in a bank account. Currently, it's paying 4.45% per annum and subject to change, but it's a great alternative to having money in a savings account. And you can have funds in your Stockspot savings account as well as in your portfolio for your child. So I'd say the main difference is probably your investment time frame for these two different accounts. If it's really short term, you could consider Stockspot savings. And if it's longer term, it's definitely probably better suited in the investment portfolio. So we've got a question here around any specific tips on how to encourage kids to save their money rather than spend it. I mean, I think this is a really good question. I'd first refer you as well to our educational content that we have on our website and our YouTube series, which covers all of the important money principles and concepts when investing for kids. But I think delayed gratification is something that I touched on a little bit earlier. It is something that's quite hard to teach kids, but certainly trying to incentivize them that they can earn more money by putting some away now and being patient, and then using some practical examples with that. Like, do you want an ice cream now or, 10 ice creams later? It's that concept of sort of being patient and disciplined, and then you will be rewarded with more down the track. But definitely refer to our blog series as well. We've got lots of blogs on investing for kids, and our YouTube channel on some really practical games as well that you can play with your kids, and that helps to encourage them to save money rather than spend it. But ultimately, I also think showing them their portfolio through the app, through the dashboard, and helping them to see the benefits of this patience and seeing their money grow, that's probably going to be a good incentive for them now. Being able to engage and have these conversations around how their money's working really hard for them is probably also going to be beneficial in encouraging them to not spend it, but rather save it. So hopefully that helps. And we probably have time for a couple more questions. So I'll have a look here. We've got one from Brooke. When the shares are withdrawn and given to the child, does the parent pay capital gains tax? Capital gains tax at their marginal tax rate. So yes, so typically if you're investing in your personal name for your child, it is your marginal tax rate that is applied at the end of the investment period. So you go to lodge your withdrawal or you do your asset transfer, and this would trigger a capital gains event for you. As I mentioned earlier, along the way, you'll be earning income from your investments, and this is typically through your distributions. Those are also usually taxed at your marginal tax rate, and that is applied to the parent's income tax as opposed to the child's. So we don't capture the child's TFN, it's the parent's, or again, through a trust, it would be the trust TFN that we're capturing. So hopefully that helps address your question, Brooke. And we'll just go through one more question. I think that's all we have time for today, unfortunately. We've got one here from Artie. So can someone let me know after or now how Stockspot fees work for these options? Certainly. So in terms of the Stockspot fees, on the website, we do outline our different pricing tiers. But I think what I maybe didn't cover earlier is around they're all inclusive. And so some of the things these cover when investing for kids is, and investing in any other account, like an individual account or even a company account, it's all of the advice that we give you. So this is the initial advice and all the ongoing advice. So each year we do an annual review with all of our clients, and for your kids' accounts, we'll be checking in with you every year. And if there's been any major changes in your circumstances or goals along the way, we can give you an updated statement of advice and let you know if there's been any changes or recommendations that we would make to your strategy. You don't have to take this recommendation, but it's something that we will do over time, is give you that ongoing advice. All the rebalancing, reinvesting your dividends, all your tax statements are also taken care of. And this is all included in the monthly management fee. So if you are on an account that's either above $10,000 when you're investing for kids, so there will be fees charged, it's at 0.66% per annum. So that's about 0.055% per month. This just comes out of your cash account. So you'll have a linked cash account that you deposit into. We'll always leave a little bit of a buffer in there of cash, and that helps to cover any monthly management fees that you might need to pay. So you won't need to go and deposit any more money into that account for fees. It's all inclusive. But I'd say for most of our kids' accounts, they're initially starting off with smaller amounts. So hopefully you'll be enjoying that fee-free period, at least for the beginning few years of the investments for your kids. Thanks, Artie. So look, I think that's all we have time for today. But look, if we have not got to all of your questions, don't worry. I will come back to you personally after the session. So keep an eye out in your emails. And just on behalf of the team, I want to say thank you so much for taking some time out today from your lunch break to join me for the Investing for Kids webinar. If you've got any questions, don't hesitate to call myself or our team of advisors. I've got some contact information on the screen, but we'd love to hear from you. So you can call us, email us. We've also got live chat. Now, if you did have to drop off, or don't worry, we will send you a recording of this webinar after the session. So keep an eye out in your emails after this. And as I said, we will definitely come back to anyone we've missed with questions. Thanks so much, everyone, for attending today, and enjoy the rest of your afternoon. See you all soon.